and you feel like you just want your forever home, then that is your personal choice, and you're also can accept that you might be seeing a 20, depending on where you are, a 20 to 50% reduction in the home price. Are you okay? And so that's what I asked them. Are you okay with all these things? And it's so funny to me that the people that are very aggressive about wanting to do it, I can get them to the point of realizing it's a terrible idea for like a million reasons. They still keep looking, and then they come to me and they're like, "How about this house?" And I'm like, "Are you willing to lose 30% on this house?" No. Okay, then why are you even asking me? I mean, like, I just like why people put me in the middle of these conversations and they don't want to listen to me, and I'm just like, well, like, why are you asking me? So what I would say is if you think you're only going to be in a house for 2 to 3 years, then rent. Like there is just no reason to buy right now. Like that doesn't, you're not saving money. It's cheaper to rent.
Welcome back, everybody. Steve Yang here with Melody Wright. How are you, Melody? Welcome back.
I'm doing well. Steve, how are you doing? And thank you. It's my pleasure.
Yeah, so I'm doing well. I don't know how the housing market is doing, but it's August, end of August now. Last time we spoke was in March, and even back then, you were talking for a while now. You've been talking about the cracks you see, and even 6 months later, a lot's happened. What are you, or maybe not's happened. So, what are you seeing right now? Where do you see the stress? Where do you see things going?
Yeah, so in March, I'm sure that I told you that we would start to see foreclosures rise, which we have up. Last month up 30 foreclosure starts up almost 40% year over year. That's Black Knight's data, so that's massive. Just a quick summary. So in March, when we were talking, what we were probably saying is after kind of we went to war in Iran, the housing market just died completely. And so, although we have at this moment, we're running about 2% of year to date sales than last year, but last year was the worst on record since 1995, and we've increased population significantly since then. So that happened. Basically, the sales just got arrested, and that's looking at both kind of the new home sales and existing sales. At the same time, what we saw, Steve, is non-seasonally. So delinquency has in mortgage has a season, and in the spring it's supposed to moderate, get way better because of bonuses, tax refunds, and if you remember, we thought everybody was going to get a huge tax refund. That did not happen. It didn't happen like it normally does. And we are seeing early 30-day delinquency, as well as what I've been talking about with you for some time. Those guardrails on the FHA program went on, and we are now seeing those flow to foreclosure. And so from here, we're just going to start seeing. So my clients saw their first foreclosure sale since 2019 in
Yeah.
July. So you got to think about that 7 years basically of arresting any normalcy in the housing market. And so when you say, I never say the word crash, I do say correction. I've been talking about it a long time because it has to happen. I mean, and that is
Yeah.
why the housing market is completely frozen. But we're going to see on the back half of the year is all those foreclosures, those sales will start to register and they'll start registering in the case Schiller. And that's going to put a drag on home prices because what's happening right now, because it's only that top 8% that are really transacting, plus whoever they can kind of get in the door with these ridiculous programs.
Yeah.
So it's keeping that median price up where we're not seeing sales. And so, for instance, the National Association of Realtors said that sales over $1 million for homes, and again, 8% of people in the US can qualify for that, were up 14% year over year. So you've got, again, everybody's talking about it. I don't care what Besant says. This is a K-shaped economy, or you can call it the I. I don't care. It's one of the two. You've just got this very bifurcated market, but we're going to start to see a real, like, it's going to be kind of if the stock market's still doing well, you'll probably get some still people buying in the housing market. but those distressed sales are going to really weigh down that median price. And we'll probably start to see that by the very end of the year or maybe early Q1.
So you mentioned delinquencies, you mentioned, tax returns, you mentioned, the stock market. What are some good indicators to kind of determine where you see the housing market going?
Sure.
Do you see a correlation that's somewhat there, unhealthy, misleading with the stock market? If you can expound on that a little bit.
Yeah, I think that's why we're seeing sales up modestly, is that, and this is certainly so in San Francisco, that housing market's been dead. But it kind of got juiced a little bit in the spring because of all the excitement over the IPOs of Anthropic, and, OpenAI. And so that's driving it, and you can see the markets where you're seeing increased kind of activity. It is those markets where you've got high, technology presence, et cetera. And so, yeah, I do think there's an unhealthy correlation because San Francisco, for instance,
Hmm.
is going to get hit very hard if we start to see even just one of the frontier models fail or not IPO or whatever. But another correlation I'd love to talk to you about, Steve, is I've been studying something called the 18-year land cycle. And this is some really great research. People that could call 2008 way before it happened just have done this kind of over centuries looking at the housing market in the United States, and that we are kind of on this 18-year cycle where we get really excited about stuff and it slowly builds. We have a midpoint kind of recession and then we keep building. And I mean, it's looking very, very accurate. But what's interesting about this is that the housing market itself peaked in 2022. Like every series can show you that.
Yeah.
So it was a little confusing to me. But then I realized what else is real estate? Data centers are real estate. And so they are part of this land cycle. And so the biggest signal to me, Steve, is when the 26,000 construction workers that are in New Albany, Ohio, some of them start going home because several reasons. One, people couldn't raise enough debt to finish them.
Yeah.
Two, they're not going to get the power to power them, or they don't have the water or resources. And so, that will be your signal of when we are really going to start the national turn. And already we're seeing distress in California, Texas, Florida, and I like areas all over the country, Denver, places like that. But it'll become a national story once those construction workers have to go home, in my opinion.
So going back to the 18-year, is it 18-year cycle?
Yeah, 18.
How far does the research go, and what can you predict or tell from the 18-year cycle, assuming that that's correct?
Yeah, so it goes back way back to the, railroad construction boom and things like that.
Before my time.
Yeah, oh, yeah, just a little bit for our time. And it goes through all of those. But what I want to do now is really dig in. There's a ton of research. I've only read a few papers, a book. I need to do more to really time this, but it's basically 18.6 years. Prices bottomed in the United States in 2012, in the last cycle. So, and we kind of topped in 2022. I think that we're probably in late year 17 or early 18, and it usually goes 18.6. And so I still think, unfortunately, we are still several months away from kind of national awareness of just how bad the housing market is.
Uh, so we talked in the past about just kind of how people were mispricing their homes, and how people have been using Zillow, for example, and
Yes.
and sellers, pretty anchored to what they think their houses are worth too. Are we starting to see that shift? Are people coming to the realization that Zillow is fictional, or is Zillow still king here, the false king?
It's the false king still, but I thought about you because I just wrote about a foreclosure just as an example of what is going to happen when these things start going to sell. And what's different this time, Steve, in my opinion, from where I sat, is back in the day during the last crisis, you had a lot of private investors who had these very complicated models of what you were supposed to bid at the foreclosure
Yeah.
auction. Well, what's different now is, 85% of all these loans are on some government agency's books, and they have a formulaic way of telling you what to bid. And so, and it doesn't care about really the size of your house, your neighborhood. The only distinction it sometimes makes is MSA, or that's metropolitan statistical area. Those are just those big areas like Miami-Dade. Non-MSA, and in a few states, specific zip codes. But otherwise, they're like, oh, it's in Tennessee. You got an exterior BP or broker price opinion or appraisal. That's going to be a 39% haircut. That's all they care about. It's not even, and so this thing, and the reason I'm saying this is this thing went for about $75,000 less than its
Wow.
estimate. And by the way, when the appraisal came back 10% less than this estimate, but this was a moderately priced home. So in my article, I say to people, lest you think you can just put a 10% discount on your house to your
Yeah.
estimate, the more expensive your home is, the worse it is. And they take listing prices, Steve. They don't even take sold prices as the way that they do those comps. And so yeah. But are more people coming to terms with reality? No, you're still seeing delisting everywhere. I've started tracking that metric. It just went up, which is also somewhat standard because we're coming out of the season and some people are giving up. And what typically happens is people give up till after Labor Day, and then they'll come wade back into the market just a little bit. And then your actual season for Florida and Arizona start in October. So for the
So
snowbirds.
the you mentioned seasonal and just geography matters, but
Oh,
typically,
yes.
what does a season look like from like this time of year till the end of the year? And are we should we expect something to be different this year?
Yeah. So typically most places it peaks in June. Like you start to see really listings plummet either in January or February, but then they start coming back up. They kind of peak in June to September sometimes. And so what we're seeing right now is kind of typical seasonal behavior. People want to make a big deal out of month over month sales being down last month. Well, it's the season. They're always down. I mean, now the seasonal adjustments are another thing altogether. And so I think people were taken a little off guard by the reduction in the seasonal adjustment, but I was not at all surprised about what I saw in the non-seasonally adjusted numbers. And so I don't think we're going to see anything too crazy, except what could start to happen as we roll through after Labor Day, September, October, and more of these foreclosure sales start to happen.
Yeah.
I think some people might get a little more aware and start coming back to the market after September, which would be a little. You don't tend to get a ton, so it'll be very interesting to see if we see a bigger increase, say around September, October, because people are starting to see distress. But right now, we're just kind of we exited this very, very uneventful season. We get the builder results tomorrow. I'm very curious. We might see a tiny increase in sales because they tend to do better in the off-season months because they can get people in, like drum up better interest because they have
No.
more listings than what's on the actual, MLS. So,
Melody, you mentioned the I-shaped structure. What is that? And if you can expound on what that means and what
sure.
we might be looking at here.
Yeah, so Peter Atwater is the one who coined the term the K-shaped economy. And then several people have said it's no longer a K, it's an I. And so here's all of us, and
The
here's
people up
yeah, the
top.
top two exactly. And so it's not even a K anymore. And and I think that's certainly true because even kind of your what I would call your middle upper K is not doing great. And they're suddenly waking up to letters in their mailboxes about these failed investments that they did and thought they were going to get a whole bunch of return on. And you're definitely seeing that, for instance, in the multifamily space because so many people, Watched a YouTube video about going out and buying some dilapidated multifamily, class B, fixing it up, putting a swing in there and a seesaw or whatever, although you don't really use those anymore. Um, and they were going to be rich. Well, unfortunately, all everybody else was off building apartments, and so
Yeah.
now you have all of this supply, and you're watching multifamily operators just implode like fireworks, and it's going to get way worse, Steve, in the fall because we've got the largest hard debt maturity wall in commercial real estate that we've ever seen, and that means there are no extension options. And what most people talk about when they talk about the debt maturity wall, they don't realize there were extension options, but now we're entering a very large hard debt maturity wall.
We talked about leverage, and you and I both know leverage can go both ways. And
Mhm.
I used, as you know, well, if you remember, I told you I had four
Airbnbs.
properties a couple
Yep.
of years ago. I've been selling them off. I only have one now. And people think of your real estate properties as assets, but quickly they can become liabilities real quick. Like, who's experiencing that the most? Is it the Airbnb people? Is it the multifamilies, as you say? And if you can also give me an update on how the Airbnb market's doing.
Yeah. I think that the Airbnb market got a little push from the World Cup, right? And so I think that, I mean, honestly, I think that everybody kind of got a little push from that. But pretty soon, those operators, I mean, especially in places like Sevierville, Tennessee, Gatlinburg, those areas, I mean, every week we're hitting the highest listings for sale ever there because the operators are doing so poorly. But I think, we probably need to see a few more months of really kind of depressed tourism. Um, for those to get super desperate. But I think it's funny, your sellers have now a lot of them transitioned to list for rent and they're not able to get people to rent either. And so it kind of takes time, but I would say who's
Yeah.
in terms of investing, who's probably experiencing the most pain right now is going to be your multifamily operators because they all got what we would consider one of those crappy loans, option like interest only, arms, all kinds of things. And they're not able to refinance because, unfortunately rates are just too high and they're being very sticky. So, everybody always said stay alive till 25. Now I say, hit with bricks in 26.
We need like a poem here.
Yeah.
We mentioned you mentioned the Iran war and just kind of people understanding how that comes into play. How does that come into play? And with Iran war, people are always going, "Oh yeah, that's just a war. That's like, or either things are going to get better, or they either explain it away." Is there something part of the Iran war that's directly affecting the housing market, and are people misunderstanding just kind of how the war is affecting it, and just kind of how they should understand where the war takes us?
Well, in two ways. One, let's just start with the basics. Higher gas prices mean, less disposable income, and it really does matter, especially for the bottom. But the other things are rates, and so the bond, everybody has some idea what's going on in the bond market. There are several things happening in the bond market, but right now it's moving with higher, oil prices, and so if those, and why are we having higher oil prices? Because
No.
by all respects, we're not moving oil through the Strait of Hormuz the way that we were prior to February 28th. And so rates are providing zero relief here. And so that absolutely, our homes priced too high, 100%. What had really gotten us post the GFC was, well, we can get that mortgage payment down to a certain manageable level through lower rates. Well, now you don't have, so home prices went crazy and rates are higher. Although, the average since 1971 for 30-year mortgage rate is 7.71%. And so we just lived through a time that was abnormally low. But yeah, the war absolutely. And then of course, we haven't even seen the food inflation we're probably going to see are higher prices. People always, quibble about what inflation really is, but we haven't even yet felt, I think, the impacts of higher prices for just about everything. And I have not confirmed this, but I saw breaking news earlier today that they ran out of diesel at the Buffalo, New York International Airport this morning. And so we haven't seen the impacts yet, but we're gonna. And that's going to
Yeah.
have a huge impact to the housing market.
So speaking of that, the chicken and the egg, is the housing market spilling over from something else, or is the housing, the stress, the pricing? I mean, what's feeding into the housing issue? Is it the effect or the cause, or does that make sense? Is it spilling over into
Yeah.
other areas, or what's the, because in 2008, the housing
Yeah.
market, you would say, was a big catalyst for all that happened back then. Is the catalyst something else and is spilling over into the housing, or is it the other way around?
Well, I don't think it's going to be the catalyst of, say, if we get a credit crisis, right? I think private credit will probably be the catalyst to a credit crisis. But, the housing market is it's just a huge part of the economy. And so whatever happens there is a big deal. I mean, whatever happened in the housing market is why we got all that spending, right?
Yeah.
During the COVID boom is like people they took money out of their houses and they did cash out refinances. Everybody likes to say is, oh, they didn't use their homes like ATM machines. Yeah, they did. The difference was that home prices just kept going up. And so that we haven't felt the impact. And so that wealth effect made everybody feel like they could go to Italy for 2 weeks and spend 20 grand or whatever. I mean, but there's nothing on the other side of that now. So once you have the reverse wealth effect, oh my, is all I got to say. I mean, you think Home Depot is not doing so great right now. just just wait until you actually start seeing on a national scale home prices. They're not even going to have to go down that much for people to start getting worried on a national level. And that is why you've seen like full court press to convince everybody we have an inventory shortage, which where you have just, said to us, well, I had four of these things. Now I have one, does that sound like if the fact that you were able to have four properties, does that sound like an inventory shortage issue? No, I mean, we had a speculative boom and that people wanted to invest because this at the time it made sense and it looked like passive income, but that now all of those fundamentals have changed. And so people like you're just ahead of the curve, Steve. I mean, I've talked to a few of you, but most people are still holding.
So when it comes to the housing market, we talk about maybe the rates the issue. Is the issue bigger than rates here, and does the rates
Mhm.
solve the problem here? If you can tell me kind of where the
Yeah.
misperception lies.
Yeah, no, it's way bigger than rates. And since time immemorial in banking, you know that people should not spend more than 28% or in credit. You don't even have to say banking, more than 28% on their household, on their home, on their housing expenses.
Yeah.
And we just blew all that out of the water in 21. Again, they took out the debt to income, threshold from Dodd-Frank very quietly. You didn't hear much about it. And they just took their foot off the brakes. And so you're looking at debt to income right now on the Fannie books at 2008 levels. Okay, well, why does that matter? Because if something happens, I just talked to someone who I know who had been working at the same company for 25 years, thought he would retire there. And out of nowhere, he got laid off. Okay. So everybody who thinks they're going to be just fine, that's not at all remotely accurate. And so, if you have just a tiny life event when your debt to income is like that, it's game over for you. And I am seeing that in client books right now. And so, it, it's very we did it again. We overextended credit, and people can say, it was tighter credit quality. I say maybe initially, But then people took their foot off the brakes, and also they were using these automated underwriting systems, which you can game. And so many people did. And so, so your question goes back to what is it? Okay, well, it's not just rates. Rates made the payment lower. We've now gone crazy and people cannot afford their homes and they can't afford their increased property taxes. They can't afford their insurance. And neither can the people coming behind them. The millennials are in no shape whatsoever to pick up the pieces from the boomers. And so it's not just rates, it's prices, it's rates, it's insurance, it's taxes, it's increased electricity
Yeah.
it's increased replacement costs. So, this was going to happen uh, regardless because people overextended credit.
So you said 28% was the number, I think. I think when I bought my house, I think it was a lot higher. I mean, with mortgage companies allow. I don't know if
Oh,
it
yeah.
was
Yeah.
40 or whatever. It's
Oh,
just ridiculous. I just,
back end DTI for FHA can go to 56%.
that's crazy. I mean, who's gonna,
It's bad
Melody, we need people to rescue us
crazy.
from ourselves.
I 100% agree. And I don't think you should be able to Henry Ford credit. It just doesn't work. It doesn't work. You don't know your customer. You can't go out there and just have these, credit is a very, in my opinion,
Yeah.
it's something you really have to think about before extending. And you can't just take a cookie cutter. Like I was telling you, they're going to do a cookie cutter price reduction to offload these properties because the other thing that agencies
Yeah.
learned last time is they don't want to hold them. But that's what they try to do on origination. But you miss so much and you don't know your customer. And I've already seen so much fraud, Stephen. We haven't even scratched the surface, man. It's going to be so much worse than last time in terms of fraud. It's everywhere.
When you say last time, are you referring to eight? And
Yeah.
then if you see fraud, can you expound a little bit more on what that means? And we keep talking about it, but where are you
Mm.
seeing it?
Oh, everywhere. I mean, and I'm looking in these Freddie Mac multifamily securitizations, and they're keeping me up at night. But it's everywhere. People made up pay stubs. They used AI, and because and so you have to understand the mortgage industry is the technology there. One company owns the main origination and servicing system. They recently did that. It's a monopoly. Those technologies were built in the late 60s, early 70s. It's terrible technology. You can't automate anything. And so when you get in a time when everybody is so busy, you miss all kinds of crap. You just make mistakes. And so we're definitely that's one reason it was some of this fraud got through. But I can't even tell you how many times I've seen things printed out of thin air. What do I mean? Okay, Steve, you're going to pretend like you're going to sell me this house. We're going to do a deed. And you're going to pretend like I paid you $2.5 million for a house that
Who
sold
who
last
are
time
we?
for
Who are we?
just two people, two
Two people.
bros. We're
Okay,
two bros.
two
We know
bros.
each
Okay.
other. Yeah, we've watched a YouTube video. We are real estate
Who we?
investors. Okay. We are,
Yeah.
and we are
Okay.
smart.
Yeah,
Okay.
yeah, yeah.
Obviously, very smart. And so you say, okay, pretend buy my house for 2.5 million. I pretend I do a deed. I say that sale went through. Then that sale gets recorded on public record. You turn around and that home might last have sold for $400,000. You turn around, you go to the bank, all that proof. You say, "Hey, look, I did an all cash sale on this," and
Yeah.
you can essentially apply for a refinance theoretically, or apply for a mortgage, and like
Yeah.
if it looks like you've owned this thing outright, and they can give you, $2 million, printed out of thin air, out of thin air.
Yeah.
And I see this in Arizona, oh my gosh. Like, because this is the thing, like through social media, all these people have So fraud just went nuts. Like maybe it was one ring out in California last time or a ring here. I mean, but this information is available to everybody on how to do these things now. And so you're going to see it. I mean, it's just like what we're watching with our politicians looting the system. Like the system has been looted.
Melody,
But
that does
go
not
ahead.
happen.
Oh, yeah, right. So, yeah, the system has been looted, but here's the problem. So, remember when, the whole was it silver scandal with JP Morgan, where on their balance sheet they had all that theoretically all that silver in the vault and it was sitting there as an asset of how many ever billions of dollars. And then somebody opened the vault. It's not there overnight. That's the bezel.
Yeah.
Overnight, you're billions of dollars short of what you thought you were. And that's what so many people are about to find out is just how much fraud was in the housing market. And on the multifamily side, Steve, we're probably going to be talking about that for a very long time. It is crazy. So,
We talked about, is it where it's not a fixed rate? Is it what is it called, an arm? What is the
yeah, adjustable
where?
rate. Yeah.
So is that kind of where people are going to get screwed the most, or is there a kind of rate that's really dangerous? People think, oh, this is a great way to do more leverage, whether it's HELOC to purchase another property or to go on a vacation. Is there a loan structure that you're seeing that people are maybe misunderstanding?
Yeah, well, so yes, but let's talk about. So they're misunderstanding that fixed rate. We'll talk about that in a minute. But the DSCR, debt service coverage ratio loan, which is used for Airbnbs primarily, and multifamily properties and office properties. So they're looking at your potential, like can you cover based on what they thought you would make in rent, and those were basically the projections were that rent was just going to go up by X every single year, and
No.
that's just not happening. But I don't like in terms of people misunderstood fixed rates because what people came in and said to them, every realtor and broker and loan officer said, date the rate, you'll be able to refi. So it wasn't even that they had an adjustable rate mortgage, not a
Yeah.
ton, it's their fixed rate they thought they'd be able to refinance on. And so, yeah. And then the other ones that really concern me, a lot of these, what we call non-qualified mortgages are interest only. They're bank statement loans, meaning you don't have to show you're employed. You can just show the same $10,000 going in and out of your account every year to make it look like you're making money. I'm like every month, which is very easy to do.
Uh,
And so yeah, I'm more concerned. I'm concerned with those who bought late 21, 22, 23, 24, 25, thinking they were going to be able to refinance. And a lot of them did buy downs too. Some were permanent. The builders used
yeah.
primarily permanent ones, but some of the agency loans were not. So, and then those will step up, but they don't look to be like a huge part. It's more that people are just overburdened with increased taxes and insurance.
So people are also misunderstanding the 30-year mortgage. And then we also looked at the 40 and the 50-year-old mortgage, if that's a thing. But in terms of people buying their houses, like you're starting a family, they're wanting a new home. Who doesn't want the whole American dream, right?
Right.
But what would you say to people? Would you flat out say, don't buy a house right now? Would you say, wait? Would you say, now's not the right time? Would you say, buying a house is never a good idea? What's your mindset on someone who's coming to you looking for advice on how they should approach and think about things?
Well, it's really going to be dependent on their life goals and what they want for their future. And so I'm never going to say don't like if you have the capital, if you have the money in the bank, you have a good job, you have a year of reserves, And I mean that a year. You have a good down payment of 20%, and you feel like you just want your forever home. Then, that is your personal choice. And you're also can accept that you might be seeing a 20, depending on where you are, a 20 to 50% reduction in the home price. Are you okay? And so that's what I asked them. Are you okay with all these things? And it's so funny to me that the people that are very aggressive about wanting to do it, I can get them to the point of realizing it's a terrible idea for like a million reasons. They still keep looking, and then they come to me and they're like, "How about this house?" And I'm like, "Are you willing to lose 30% on this house?" No. Okay, then why are you even asking me? I mean, like, I just like why people put me in the middle of these conversations and they don't want to listen to me, and I'm just like, well, then, like, why are you asking me? So what I would say is if you think you're only going to be in a house for 2 to 3 years, then rent. Like there is just no reason to buy right now. Like that doesn't, you're not saving money. It's cheaper to rent like
No.
significantly all over the country. But it really is a personal thing. And I do believe in home ownership for sure. Just what I don't believe in is overextending yourself into debt slavery. Um, for a home like that, you could go rent for a couple years and maybe longer. And I know it's so unaffordable right now. It would have to be longer to save up for that down payment, but you can get a cheaper, rent than you
Uh,
can a payment. And so that to me is the smartest thing to do right now and to really negotiate on that rent as well. But it's always going to be a personal choice. Just don't get overextended. Yeah.
Melody, I learn from you every time I talk to you. One, you're enjoyable to talk to, but I consider you an expert on the housing market. I asked you off camera, and I want to ask you on camera now. Is that what's in it for you? I mean, you're not a realtor. You don't make money off selling homes. So like, what motivates you to do this? And what drives your passion?
Yeah. And, like I said to you, what motivates me is saving that young couple from, making a terrible financial decision that could wreck their family, their marriage, because people fight the hardest about money, and when you have the stress, and often it's young families with new babies that really want to buy a house. And so the most stressful time of your life with a new baby, now you're suddenly a homeowner. But for my parents, when my mom had to go to work in the 70s, because inflation and my father's paycheck could not cover everything. They lost their house, so we lost our house, and so I really just want to explain this industry to people. Show them what it is and keep them from making a terrible financial decision. And I really do think about all those young Americans out there who might be signing the dotted line and not realizing what they're signing up for just because they think their neighbors have done it, just because that's what everybody on TV does or whatever, or on YouTube. So that's really what drives me is just education, and also just general financial education because our in our education system in this country does not teach this at all. And I've seen it. I mean, just burden people for, you know, years. Think about student loans. People have those things forever, barely paying anything down, all because they showed up on campus, without a trust fund. And the first thing they got was a credit card application and a student loan. And that's what we teach our kids. If you don't come from wealth, that's what we teach our kids in America. And I want that to change.
I love it. Melody, it's August 24th. As we head into the next quarter and beyond, what are your predictions, expectations for the rest of the year? And is there something you're keeping a close eye on?
Yeah, so from here, we are definitely going to start to see those foreclosure sales increase. We're also going to see delinquency increase because now we are actually entering the delinquency season where you always see delinquency kind of peak in December. So we're going to just see more and more of that. We're going to see more of these FHA borrowers fell out of their loss mitigation plans and have to go into foreclosure. I think, we're just going to see inventory build at the builders because whatever they tell you they have 25% more. I've seen it. And so, we could skate through the election without a lot of like, fireworks in the housing market. But really, by the time we get to late Q4, so I would say November reporting, December reporting, and so that could actually we could get that reporting in January. You were going to see these distress sales weighing down prices, and it's going to be a topic of conversation. I see this debt maturity wall happening in Q4 for commercial, which could, I think, private credit and commercial were really best buddies last year, and private credit offered like 25% of all the refinances last year in commercial real estate. So I think those two are going to tango in the fall, and we're going to hear about Blue Owl some more. We're going to hear about Cliffwater some more, and I'm sure we'll probably see that once when we get to Q3 reporting. And so I think that could cause some fireworks. And then, of course, every day we get some story that just puts another tiny little pinprick in the AI bubble, and the data center bubble. And also private credit is huge in these data centers. So we could get that explosion in the fall, or maybe Q1. But I don't think that has a long way, a lot of life left in it. Put it that way.
Melody, where can people follow your work and learn more from you directly?
Sure. So you can follow me on my Substack at M3 Melody Substack. And that's where I write about the housing market, about macro, and I track 86 markets. So I do micro as well. And then, of course, on X Twitter at M3_Melody.
Awesome. Well, Melody, thanks for being here. It's a true honor to have you every time.
Thank you for having me. My pleasure.